Hi, this is Scott Lowe. It is March 10th, 2010, and today the market was flat. The Dow was up 3 points, S&P 500 up 5, and the NASDAQ was up 20 points. And I would like to say congratulations to Genco Shipping and Trading Limited. They successfully launched their subsidy Baltic Trading Limited today, which I discussed in a previous video. They raised $224.3 million. The share opening price was $14. The high for the day was $14.07, and they closed a little below what they opened at, $13.93. But congratulations, and I hope that your forecast is correct in regards to tanker rates going up, or not tanker rates, shipping companies, or dry bulk shipping rates going up. I personally won't be participating in this investment for at least 2 to 3 quarters because I still feel that there's a lot of uncertainty in the market and there's a lot of volatility, and I don't think that cargo shipping rates will go up dramatically. I still want to stick with my Genco position. They have long-term contracts which generates stable cash flow as well as some exposure to the spot market. So this is a little bit more of a defensive play, but I will keep Baltic Trading Limited Company in the back of my head, ticker symbol BALT. So if my analysis of the market changes, then this will probably be one of the companies I will be focusing on. Now, even though the market was flat today, my positions, they were up, and my overall portfolio was up 2.63%. And I right now have a lot of my positions in the transportation / energy sector. One of my best holdings and biggest holdings right now is Frontline Tanker Company, ticker symbol FRO. It was up 6.44% today, and I've held this company for about 10 to 12 months, and I am right now showing a 44% gain. I have seen a 50-55% gain, but I didn't sell it. I held on to it. But this company, one of the reasons why I'm holding on to it is because of the dividend payout that they have and the potential for greater dividends in the future. Before 2007, for any 3 consecutive months, you would see this company pay out $5 to $6 each year on an annual basis, and that's pretty large. Right now, they're only paying a quarter each quarter, and I think that when the economy recovers, we'll see this dividend increase and distribute more cash to their shareholders, and hopefully to me, so that I can keep on reinvesting in these investments of mine. See what else here. Genco was up 2.8%. Yeah, that's about it. But I won't just be talking about my successful investments or my successful positions. I will also be speaking about my losers that I have held and dogs that I have in my portfolio right now that no investor wants to talk about, but they're there. They're just a pain in the you know what. But yeah, today I want to be speaking a little bit about death and taxes. But Adam Smith says that 2 things in life are certain: death and taxes. And though I don't know where I'm going to die or when I'm going to die, I can control the amount of taxes that I do pay towards the federal government. If you're a long-term trader, you will probably be able to take advantage of long-term capital and long-term capital gains and long-term capital losses. If you're a short-term trader, you'll be concerned about short-term capital gains and short-term capital losses. And also, if you're a short-term capital trader, you might want to pay particular attention to the wash sale rule. And that's if you buy a position and then you sell it within 30 days and you sell it at a loss, you won't be able to take advantage of your short-term capital loss. You have to add on to your basis, and so you just have a higher basis and you can't take advantage of that loss until you sell it because you've purchased it in 30 days. Now I hope that isn't too confusing for you, but if it is, just let me know and I'll go over it a little bit more later. But as a trader, that if you own a stock for, let's say, 1, 2, 3, or 4 months, you're going to be paying short-term capital gains, and as a long-term trader, you're going to be paying short-term capital gains or loss rates, and those rates are usually 15%. Short-term is 25%. Now, right here, even the best investors in the world, they always think about taxes. Paul Tudor Jones, George Soros, and then you have John Paulson, who took advantage of the subprime market. Now, their investment strategy is to take advantage of these inflection points in the market. Let's say that the rise in the real estate market right here from 2003 to 2007, this would be the sentiment in the market, and then all of a sudden, boom, you have a huge crash in the market. Now, usually when you short something, when the market goes down, it happens a lot quicker than it goes up. So this is how George Soros and John Paulson took advantage of the subprime market. They bought credit derivative swaps right here, and then they just saw their positions just dramatically increase as the market went down. But this right here, these traders that take advantage of these inflection points in the chart here, these are the trades that create legends on Wall Street, and these are the legends that also have to think about taxes in the back of their head of all the profits that they do make on a short-term capital basis, because the second that the market sentiment changes from good to bad right here, they're already thinking about exiting the position. They don't want to hold it for this recovery, and it could take 3 to 4 years. No, they're out of the position probably right around here, and so they're going to have to pay the short-term capital gains rate, which is a pretty high 25% rate. But if you hold positions for a longer period of time, especially if you're a long-term investor, you don't have too much money in your account, you might want to think about taxes in the back of your head a little bit, just so you don't have to pay as much, and so you're able to better analyze your positions and spend more time researching them, so that you don't have to be in and out of position within a short period of time when you can hold them. But another position that I have been keeping my eye on is Citigroup. Citigroup has actually been doing very well lately. You have David Tepper from Aeropostale Management in this company, John Paulson in Citigroup, and I think they're I know that David Tepper's average rate is below $1.50. John Paulson, I'm not quite sure, but you have a lot of hedge fund managers invested in Citigroup right now, and so I think that this is a speculative play right now, but I don't think there's too much downside, since you do have the federal government as a backstop to bail out Citigroup or to lend them more money in case they go, they lose more value in their stock price, or if the economy goes down again. But Citigroup is definitely a company to keep an eye on, because the market cap on this company right now is only $112 billion. You have Bank of America, which is one of their closest competitors, at $127 billion. Oh, actually, $171 billion, excuse me. And then you also have Wells Fargo at, let's see, what's their market cap? At 153. And so for a huge company such as Citigroup to still be trading at $4 with market cap of $112 billion, I think that compared to its peers, it's a dog, it's a lagger, and if you believe that there's going to be an economic recovery, or if you think that it should be trading within its peer range, then you'd want to invest in Citigroup so that you can make a profit. Now, 110 billion to 150 billion, that's a profit of about 30%, and I think any trader would be happy with a 30% gain in a short period of time. Now, this is Scott, and I want to thank you for watching.